Test, mic test. All right. All right, we're good.
Ooh, I can hear you.
You can hear me. We're live from the Rodecaster Pro 2. All right. 3, 2, 1, go time. All right, friends, welcome to G Money, Real Talk, everything mortgages and real estate. Today I have a good friend and colleague, Jason Ritchey. Jason, welcome.
Thanks, Ray. Happy to be here, man.
Awesome. So Jason is with Mission Bank, and what's your official job title, my friend?
My title is Regional President, which today means I'm the president of the region of Ventura, which is one office today, but over time that'll grow.
I love it. Well, Jason and I were, prior to the podcast, we were just kind of chatting about cold baths and some Joe Rogan episode that we were listening to, and Jason is a cold bather over here. What's the
Fairly
official
recent.
term? Yeah, what's
Cold plunge.
Cold plunge. You like?
Can't recommend it enough. I'm very addicted, and addicted is the right word.
Yeah, so he gets into the 30 to 40 degree ice cold water, and it's very therapeutic. Actually, listening to all of the health benefits, it's quite amazing.
It is, and you can feel it before you even kind of look into the benefits. You know, all of it makes sense because you can feel it for 4 or 5 hours after you've done it.
Oh, I love
Painful when you're in there. Painful specifically before you get in there because your body's screaming at you not to do it.
Yeah.
But once you finally make that plunge and get out, full body and everything, get out, you're on fire for hours.
Oh my goodness. Ugh.
Can't recommend it enough.
Well,
got to get one in here.
Maybe. I will try it. I'll give you that. I will try it. Why not? Try everything once.
Yeah, there you go.
I'll be the next addicted one. So cool. Well, thank you for joining me today. Again, I run this mortgage podcast, and I like to have, different industry professionals come on. You with the commercial bank, a couple different aspects. We're going to get into this. But I want to kind of just talk about the overall banking system right now and the false panic that's out there, just for us to address that. And then really, how do I know Mission Bank is, I have a commercial loan with Mission Bank. And so, I'd like to talk about commercial loans. I'm going to say they're similar to mortgages, but really they're quite different. So it's good for people to understand the differences. So before we get into all that, let's, start out. How do we meet? You're Central Valley boy, right?
That's right. Born and raised in Fresno.
Fresno, okay.
That's right.
Are you a bulldog or?
Yeah, I'm a bulldog.
Okay.
I can't say I'm following them super closely anymore, so I'm not being a true Fresnan like I should be. But yeah, I grew up going to Fresno State football games, basketball games. A lot of memories, man.
Oh, cool. I know you played sports, and obviously this is where it's led to the cold baths. Basketball, baseball, what kind of sports did you play?
As a kid, played them all, as a lot of kids do. But by the time I got kind of through junior high, basketball was my kind of one love. So been playing that since I got into high school kind of full time, and took me to college, which is what brought me down here.
Okay.
So I played basketball all the way through high school and got, lucky enough to get a scholarship to a small school called Westmont in Santa Barbara.
Oh, nice.
Montecito area, specifically. And, I don't know if you've been to the campus, but once you're there.
Beautiful.
Yeah, it was pretty much like a 5-minute decision for me.
It took that long, right?
Yeah.
Wow.
Dude, checked the campus out, the weather out, because Fresno's weather's not as forgiving, and then met the guys, and I was like, yeah, if you guys will have me, I'm coming.
Oh, wow. That's cool. And then, so Montecito's the upper echelon of Santa Barbara, and that's, 20, 25 minutes down the road. Mm-hmm. After college, how do you wind up in Ventura?
Yeah, so while I was going to school and playing basketball, probably about halfway through my sophomore year, maybe early junior year, realized I'm not going to go to the NBA.
Okay.
It took me a little longer than it should have to come to that realization.
Larry Bird didn't call you up and say, Jason,
yeah. And I'm still holding out for the Lakers to call, but, I chose to settle down with my wife instead of pursue. That's what I tell myself anyways. Yeah. But so, at that point, I kind of realized I wasn't going to play pro. So that, the logical next kind of thought is like, well, what else am I going to do? And so at that point, I started taking school a little bit more seriously. Actually found, and it timed well because you usually get all your general ed stuff out in the first 2 years, right? And then you start to dive into kind of the stuff that's specific to your major, which mine was economics and business. And so it timed well because I started to pay more attention and found that this stuff's actually pretty interesting. Yeah. And then specifically stuff related to kind of the financial markets and things like that was really interesting to me. in economics. And so not only was I paying more attention to school and learning a lot from that, but I was also kind of looking for job opportunities, which started with, part-time at Wheel Fun bike rentals, things like that. But eventually found this job as a underwriter for a commercial loan broker.
Oh, wow.
In Santa Barbara. Really good dude, really just an awesome situation that I kind of like lucked into, just happened to apply and get it, and turned to be a great situation. And kind of, so that was my first exposure to kind of underwriting loans and things like that, and how that whole world worked. And then right as I was starting to graduate, kind of the second semester of my senior year, I was still doing that. So I was working that part-time. In the summers where I started, I liked it enough and found that my schedule, my senior year, worked out well enough to where I could continue to do that part-time while going to school and while playing basketball. But I was introduced to a guy who's still my boss today through a teammate of mine, longtime family friends with this guy named Brian Easterly here in Ventura. And he was doing, essentially a relationship manager, loan officer for a local community bank,
Right.
crushing it, so busy that he needed to bring somebody on to kind of train, to kind of help him out.
Right.
And so we met through mutual friends, essentially. And so I still, even though doing the underwriting thing for that loan broker, I still really had no idea what this job consisted of. I thought I knew what banks did, but realized I didn't pretty quickly. And so I was mainly just like, I need a job. I need to be able to pay for rent. I don't want to go back to Fresno. Sorry, Mom. I love you, but I didn't want to live there. I wanted to stay here. And so took the job, not really thinking much of it. And the more I learned about it, the more I stuck with it. I was like, this is actually really, really interesting. Banks are not these like government entities that just hold on to money. There's a business behind them.
Right.
And it's actually really interesting. And particularly the community banking aspect, I just really loved the hands-on handshake. Let's sit down and figure things out. It feels more like you're making decisions and taking ownership of the process, but also kind of benefiting the community along the way, because you're working with those small to medium-sized business owners in town that really are kind of the backbone of any community.
Yeah, absolutely. No, yeah. Great story. I love it.
Yeah.
From Fresno to Montecito to Rising Star here in Ventura. Well, great job, Jason.
Yeah, thanks, man. Appreciate it.
Yeah, so Jason and I, we met through Rotary, and can't say good enough things about Rotary. It's been a great part of my humanitarian history of just giving back to the community. I've traveled to India, I've traveled to Nicaragua, many different places because of Rotary. And that's where you and I met was, I think probably when you got the position with Mission Bank and tried to, show up and represent and support them. But the good part about Rotary or any humanitarian work is really getting to see somebody's true core. And so when you're there for the right intentions and seeing somebody give back, to me, this is, again, why we're friends and why I appreciate and value everything that you do. And, here we are years down the road, and my wife and I, we've started our own nonprofit, and guess who we've called upon, and guess who's shown up, not just shown up, but you've brought your wife, your fellow colleagues. I mean, it's been great. So I appreciate the support, with the humanitarian work as much as what we do day to day to make money. Right. Yeah. So it's nice doing something that we love, but ultimately it's our job. And so I feel it's always great to kind of give back on a whole nother channel, a whole nother perspective. So, yeah,
I want to give you and Sarah some props with Love Ventura, because it's one thing, and so not to knock it, it's one thing to join a club like Rotary and give back to your community that way. I can't even really speak to how much work you guys have had to put in to start your own thing and really try to kind of give back that way. I can't imagine the amount of work that was. So I appreciate you guys doing that and really being another kind of facilitator of ways that me and other people that I know can give back to the community, because it's so important.
Yeah, awesome. Thank you. And I'm going to pass that torch to my wife. I mean, I have a lot of great ideas, and I feel I strive hard to, if I commit to say I'm going to do something, I'm going to do it. And so I don't want to just be that talker. It drives me nuts. And so, a lot of the minor details, the day in and the day out, the grunt work that's not fun to do. Sarah, my wife, another big shout out. She's amazing, and she just triumphantly does that. She balances working, she balances children, and her passions are her passions, and it's something that she's always been a part of giving back, from her early years. She was the poor family that was donated to at the holidays. And so she knows what it's like. And I think that's why it's a non-negotiable, in our relationship. It's just always something that we've done. We didn't want to reinvent the wheel, but also, and again, no disrespect to Rotary. They do a great job. They're one of the largest nonprofits in the world, and how many lives they touch and what they do. We just want to have more of a hands-on approach, and that's who we are. It's, Rotary has great lunches and great guest speakers, and again, I've got to travel with Rotary, but I'm a hands-on guy. Get me in front of somebody, and let's just do it. And so, with that, I'm also from the Central Valley, good old Modesto, and when I moved in 2010, I would go back and visit friends. And I saw these signs that said "Love Modesto," and I'm just scratching my head of like, who loves Modesto? Is this a joke? And this is like peak foreclosure crisis. How many abandoned and vacant homes there were, and I mean, the homeless population's been going strong for a long time. And so I kept asking friends, what's this Love Modesto thing? And so it was a date where they tried to get everybody to come together as a community to improve and better what they're doing. And so, wow, what a concept, And so we kind of took that to heart. And after enough time, we reached out to them and said, tell us what you're doing. How do we get involved? And so we formed our own nonprofit. It is a true 501c3. The parent name is Love VC, Love Ventura County, purposely so we can grow this. Everything I do, I want to look down the road of how do we expand and grow. And so it was one of those of, there's a lot of cities in Ventura, from Ventura where we work and Oxnard and Camarillo and Ojai, every town has their pride and their love. And so it's good to give back. And so the movement or the work day really is the Love Ventura. Yeah. And so, again, rather than reinventing the wheel, what we do is we partner with other nonprofits. There's so many good nonprofits out there, from Surfrider that does beach cleanups. Why would we go try to improve what they've been doing for years and what they're huge advocates for? But then we say, hey, Surfrider, let's do a beach cleanup on this one particular day. And then across the street, we have Bike Hub where, they repurpose bicycles. And if you don't have money, you can go in and work it off. And again, it's another nonprofit to really support the community and get them on two wheels. And it doesn't have to be about money. Well, let's repair a whole bunch of bicycles on that day. And so, before we knew it, our first big day was being planned out from kickoff at a community park right in the heart of Ventura with, breakfast donated from Chick-fil-A and live music and different vendors and everybody wearing a Love Ventura shirt, to really seeing the camaraderie of how this can become a movement of, again, it's cross between that pride and also giving back. Before I really got into volunteerism, I didn't, it was always like, I thought you had to do it on holidays, or maybe that was the easiest way to get involved. And so I was very timid, and I feel like a lot of people are. They don't know where to enter or to dabble into how do I volunteer. And so having this platform where we offer a plethora of different nonprofits, it's really to introduce you into what type of projects or volunteerism that you want to work. Is it encouragement and just sitting and hanging out with some seniors or some veterans? You worked at the veteran home, or is it a hands-on where you're actually, doing yard work and again, the hands-on of shrubs and bushes and getting down and dirty and sweaty, and, there's a little something for everybody. And what Sarah and I as parents are trying to do is really turn this into a family-friendly event. Teach our kids at a very early age, look how easy it is. That's and awesome. Look how, just a little bit here and a little bit there, how much it means to somebody else. And so, it was one of those that we didn't come up with the initial concept. We brought it to the Ventura area. We take pride in where we live, where we work. and we've hit the ground running. And so we hope to continually grow this. I'd love to see a day that we're shutting down Main Street and we've got 5,000 volunteers out there just raring up to say, let's do this. And, throughout the year, we also have additional projects, the holidays, and we've got an upcoming thing at Topa Topa Brewery in April. So check the website for Love VC. But yeah, thanks for shifting gears and kind of getting me blabbing over here about our nonprofit. It's been fun. And it's been very self-rewarding, and I feel like, again, it's gotten me more and more passionate about the community and the community members, for sure. Yeah.
You said something earlier that hit home for me. It can be a little intimidating because you're kind of like, I want to give back, I want to help the community. There's a lot of people that are probably thinking that same way or feeling that same way, but it is a little bit like, where do I start? How do I do it?
Yeah.
So having people like you out there creating organizations like that, right? Or bringing an existing organization, but bringing it here, it makes it a lot easier. That Love Ventura Day was just like, there was just such good energy involved in that whole thing. Just knowing, I can only do one project at a time, but knowing that there was multiple going on at the same time made you really feel like, man, Ventura's going to be slightly better by the end of this day. And I played some part in that. And it's awesome, man. So I'm really looking forward to the future projects that you guys put together. And I have no doubt that it's just going to get bigger and bigger, because not only myself, but everybody that I was kind of involved with was all kind of in agreement that, like, gosh, what a great day.
Yeah. Awesome. Well, thank you. Thanks for the feedback. And again, this is the heart and core of how I met Jason, right? So through Rotary and some of the projects that we've done through that. And then again, when it came to Love Ventura, it was kind of a non-negotiable. And he's not even telling you the best part, that he wasn't just a volunteer, he was a team lead. I hit him up of, Jason, I need you. I need you to kind of manage this site. And you graciously accepted after you kind of learned what you had to do and all that. But it was at the Veterans Home in Eastside Ventura, which I had never been to before.
Same.
And wow, what a facility. I mean, good for them. And I know you guys did a lot of like yard work, and you were digging some trenches.
I don't even do it at my own house.
And there was, other teams working on, looked like backstops for the horseshoe pit. And I mean, just a variety of different projects that meant so much, I'm sure, to the veterans that reside there, and even the employees, of somebody just caring, you know, like, that's awesome. So thank you again for all that you've done and partnering with us in so many ways. So, well, let's talk shop. So, I mean, where do we even begin? Let's just get the elephant in the room. I feel like, I basically called you as soon as I saw the media just taking havoc of small banks, and the banking industry is going to collapse. And it's just like, oh, come on, guys, fake news. Let's calm down. Let's not turn this into a toilet paper situation where everybody's scrambling to run to their banks and pull cash out. And so, just maybe explaining for those that don't understand or don't have that knowledge. Why don't you just kind of share? It was 3 banks that went belly up, and there was a lot of buzz about that. There's a lot of scared consumers about that. So let's get your banking take on this, please.
Sure. Yeah. I mean, it is, it's a topic that's probably, could use multiple podcast episodes, as you can tell with the amount of kind of material that's out there. But, I don't want to say something like this is a good thing, but the kind of silver lining in it is it really forces people, especially people like me that are in the industry, but people that aren't in the industry, to kind of learn a little bit more about just how this whole system works. Absolutely. Like, if you're really taking the time to figure out what went wrong with SVB, and I'll probably talk mostly about SVB because there were 2 other banks, as you mentioned, and a few others that have been hurt by it. But SVB's kind of been the one that there's the most information on, because they were the largest of the ones that went down, second largest, bank failure in the history of the country. So just huge, right? Yeah. So, but what happened with them, the big picture of this, the interesting thing about it that is kind of obvious in hindsight, but it just isn't at the front of most people's brains about bank, is the whole banking industry is a confidence game, right?
Right.
You put your money in a bank, it's, because you're not going to keep it under your mattress. You're not going to put all of it in Bitcoin, maybe some of it, but not all of it in Bitcoin. So where do you put it? You put it in banks, right? And I think all of us know this, but we don't think about it on a day-to-day basis. That money is not just sitting there in a vault, or even sitting there in the bank's vault somewhere else, like in the corporate office or something like that. That money's not sitting there.
And let's pause on that real quick. So everybody listening, let's just think about that. You walk into, whether you're a smaller local Mission Bank or you have a big box bank, Chase, B of A, it doesn't matter who you are. You most likely have a free checking account, right? And you walk in and there's staff, there's a manager, there's loan officers, there's tellers, there's a variety of different positions. They have to pay everybody. And so when they're not charging you for the services of holding your money, what they have to do is they have to turn and reinvest your money. And so, here's the way it goes. There's banking laws that there needs to be a liquidity amount that they retain on hand. And that is merely 10%. I mean, it's not 50%, it's not 90%. Why 10% is because, again, we have to instill trust in the banks for them to do what they need to do. What they do is they reinvest money. You go and you get a car loan, right? And so you're paying 4, 5, 6% on a car loan, and then the bank has a small amount of profit that they're making, right? Because they have to pay fees and they have to reimburse some of the long-term CDs and things that they're paying out on. But ultimately, as Jason's saying, they're reinvesting their money to be able to provide these services and to be able to exist. And so a lot of this is being, when you're the top brass, what do you invest in?
Right.
How long of these investments, there's a difference from a 5-year car loan and a 30-year mortgage. What you're investing in really can impact the cash flow. And so just, I'm going to spin it back to you, Jason. I just want to kind of have that picture painted of how do banks work and, kind of what they have to do to be able to survive and provide the services that they offer.
Yeah, you bring up a good point. Banks are businesses too, which again, for me, when I first got into it, I didn't really think of them that way, right? I wouldn't have said that they were like government entities, but I almost thought of them in that way as just this like thing that exists and has always existed, which obviously isn't true, but it's just kind of the way that I thought about it at least. But they are businesses and they have to make money. And so there's essentially, there's two ways mainly to do it, which is how they invest that money that's coming in, or if they hold on to it, they charge fees for it, right? We're in a world today where nobody wants to get charged any fees at all. Mm-hmm. So most banks don't charge any fees to hold the money. So even more so, they have to invest it in a way that's appropriate to get a return, to pay all the staff, to pay for the rent, to do all that stuff. And so all that to say that the money is not just sitting there. And in fact, there are a couple places that try to do it in a way where they basically do hold on to it and then charge fees on the accounts and stuff to kind of, that's how they generate their income. Weirdly, the Fed doesn't really want banks to do that because they want us to kind of be incentivized to put it back in the community. They want they want us to kind of be encouraged and incentivized to spur the economy on. So if we just held on to all the money and charged fees for it, then the money is not going back to you to buy your commercial building or somebody else to buy their car or somebody else for the line of credit to grow their business and things like that. So it's kind of trying to find that fine line of like creating enough safety for the customers so that they feel comfortable with their money being there, but also it being put to good use so the staff and all the other kind of fixed overhead expenses for the bank, there's enough to support it. Plus we're kind of encouraging growth in the economy and stuff like that, not just locally, but nationwide and worldwide. And so then it becomes, if we're not going to do it based on fees, we're going to do it based on kind of generating income through investments or through loans, which are essentially the same thing in terms of investments. It's about how you do it, right? And every bank has a slightly different philosophy. You mentioned the 10% kind of, and that's actually higher than it was before, right? So there was a lot of changes that made things more safe than what happened in '08. So we can talk a little bit about why this is slightly different than '08, even if it does lead to something worse than what's happened so far. It's a different situation entirely, and part of it is because of the lessons that we learned in the additional regulations that came out of the '08 recession. But to kind of narrow the scope back to SVB, the primary assets on every bank's balance sheet are loans or kind of investments like treasuries, mortgage-backed securities, things like that. as kind of income producing things. And so with loans, they're good for all kinds of reasons, but they do pose some sort of credit risk, right? There is a risk that somebody doesn't pay back the loan, and that's a bummer. You have too much of that, you go, things aren't good. That's what happened in 2008.
Right. And like Jason's saying, how is it different? I'll just kind of interject real quick of the mortgage side. It was the perfect storm of a shit show, 2008. We had very, very creative lending products. You could essentially purchase a home with no money out of pocket. We would do an 80-20, and we could do that as a stated income, so you didn't even have to verify your income. And so here we have a mortgage product that you could have been anybody, and with a few little signatures and a few minor verifications, you had a loan on 100% of this home. Now, that in and of itself is a huge risk, right? You purchase something for, back then, a nice home was $400,000. You have this $400,000 home, and you've borrowed $400,000 on the home, and if times get a little tough, you can't even sell that home, because just for you to list the home is realtors and closing costs. So 6, 7, 8%, let's just say, on selling your home. You would have to write a check for, $32,000 just to sell your home. Now, the second part of this is, who's going to do that when they literally brought nothing to table? You are not as invested into the property itself. So you have an over-leveraged buyer. Then we have supply and demand. And back in that era, I was living in the Modesto area, and I can tell you all the surrounding areas from Bakersfield, Fresno, Clovis, Madera, Merced, Modesto, Stockton, Riverbank. It doesn't matter. You could drive down the highway and see that they were building track home after track home after track home, and so now you've oversupplied the demand, and so we have a supply and demand issue. We have an over-leveraged borrower issue, and then now we introduce the banks that had a very low, and I don't know the exact number back then, but I do know it was below 10% liquidity that they were required to have, but they were also investing in mortgage-backed securities. And so there was a certain point that this needle just kicked up to the red zone that says we've invested in these defaulting loans. And so it was soon that the domino effect, that this whirlwind or tornado, whatever you want to call it, they went down in a vicious cycle, and it went down together. I mean, it was, I get time and time again, people are, oh, I'm waiting for the next crash. You know what? There's not going to be another crash. I mean, I'm not to say banks are going to collapse, because we're talking about that now, but we're not talking about that with a liquidity issue, with bad mortgage products. We're not creating that perfect storm again. Hopefully, we've learned enough, and I feel that I'm speaking on behalf of the mortgage industry. The pendulum swings back and forth, right? You go way too loose, you go way too tight. I feel that the pendulum is in a good little healthy swing. And I had a conversation last night with a client, and I said, here's the good thing: I cannot overqualify you. It might seem like an expensive mortgage payment, and I'm sure it's a lot more than what you feel comfortable with in terms of rent, but we're still leaving enough meat on the table that with a good household budget, you can do everything that you want to do. We are not here to, over qualify you that you're going to, qualify for $1 million home on $20,000 of income. Your income is there. Now, how you feel comfortable and how you typically spend it is different, but it's at a good pendulum swing where the guidelines are very reasonable and rational for them to qualify and meet the guidelines and have a healthy mortgage that, if they stop receiving bonuses, or, hey, maybe they're cut back 8 hours a week, things get tough and we all face difficulties, but you're still going to be able to make that mortgage payment. That's ultimately what we're concerned with. So I kind of stole that away from you, Jason. I'm sorry,
No.
but let's bring it back to the Silicon Valley Bank and specific maybe to them. I know you have some good information of what caused their collapse.
Yeah. So everything that you just said is super helpful and kind of in light of this conversation, because essentially, if you can kind of boil it down to what happened, there's a lot of interconnected stuff, and it would take too many hours to kind of talk about what made up all of that or what caused it. But essentially, you can boil it down to that was credit risk, right? What we've got now, specifically, if you talk about SVB, it was duration risk, right, if you will, or interest rate risk is another way of putting it, where there was a significant flood of deposits that went to them, customer deposits, right, which on a bank's balance sheet is actually a liability because it's not theirs. They actually owe that money back to those customers, right?
Right.
And part of it is related to the customers that they focused on, the tech world, the VC, venture capital world, right? A bunch of money can just flow in, right? It's just like how that industry works, and they were like the bank in town for that. So everybody and people in the same industry talk to each other. So all that money just starts to flood in. So they built themselves a nice niche, and it was working out really well for them. I think they were the 16th largest bank in the country, 16 or 20, something like that. But huge bank, right?
Yeah.
And pretty much all customers in this tech space. And so that industry as a whole had a bunch of deposits just generally, but then you have the amount of money that got flooded into the market through PPP loans and other government stimulus as a result of the pandemic, right? So jacked it up even more, just a shitload of money.
Right.
It came in, right? And so SVB, it's actually kind of seen as irresponsible, even by regulators' standards, for them to just hold on to that money. So they got to do something with it, invest it somehow. And so you can lend it out, but you can't really lend it out at the pace it came in,
Right.
while still meeting kind of good underwriting standards, right? And not taking on too much risk. So you can't lend it out that fast. So they chose to invest significantly into treasuries and mortgage-backed securities, things that they, at the time, considered to be risk-free. Because from a credit risk standpoint, they are risk-free, right? You know that treasuries are going to get paid back.
Correct.
So what happened was the money comes in, they choose to invest a significant amount. And I think they were up to like 55, 60% of their assets being held in those types of investments, right? Versus loans and things like that. Then the Fed starts jacking up interest rates to start fighting inflation, right? So I don't know what the exact numbers would be, but they've got a bunch of treasuries that are like, 1%, 1.5%, 2%. And all of a sudden, interest rates are jacked up at literally, as a percentage of growth, the fastest it's ever been done.
Correct.
Right.
And now it's devaluing everything that they've invested in.
Yeah. So, just for like round numbers, like you put $1,000 into this treasury at 2%. Now rates are at 4%. The value of that $10 asset just went down to, I don't know what it would be, but like $750, let's just say. So you couldn't sell that to liquidate it to get the cash to give back to your customer without taking a haircut on it, right?
Yeah. And when you've got 60% invested in that, oh, wow.
Yeah, exactly. So kind of a perfect storm with timing. And so they had a significant amount of that. And who knows what the internal conversations or the conversations were with regulators. There's all kinds of speculation of them being warned about this, but generally, you can kind of assume that they consider this to be risk-free and it being fine. But the interesting thing about banks' balance sheets and the way that they have to report them is they can report them on their financials at that kind of cost value, right? So they can still show it at $10, but in the footnotes, they kind of have to do some sort of mark-to-market value. And anybody that's kind of paying attention, which a lot of their customers are sophisticated people, and so looking at those financials, they're kind of seeing that like, oh, all these assets are not worth 10, they're worth $7 now. And so they're actually showing significant amounts of unrealized losses. And so they are, insolvent. I'm saying that in air quotes, right?
Yes.
They were considered to be insolvent. And so you combine all of that stuff, which is a dangerous place to be in when you're a bank already, with the way that not only information moves these days, but the way money moves these days. It used to be a lot harder to pull $1 billion out of a bank. Now it's pretty dang easy to pull $1 billion out of a bank. It can happen, literally in a day. And so there was enough people going around, tweet storming and things like that. Customers saying, "Get your money the hell out of there," and it happened, right? Like 42 billion came out in like a matter of a day or 2 days. So it went from being like this thing that, hey, maybe we should be slightly concerned about this, to it's too late to do anything about it.
Correct.
Just like that. So money just started flowing out, and so they had to kind of.
And that panic, that's I'm going to kind of stop you there.
Yeah.
That's what perpetuates and made this different. I think had $2 billion come out instead of $42 billion, we'd be talking a different narrative right now of what happened to that bank. And so this panicked approach of, oh, I need to go get my money and I don't believe in banks. Well, let's break that down. I mean, the banking industry is insured. FDIC, they insure your deposits up to $250,000, and now that number is kind of even being questioned of maybe they raise that to half of your investments, or there's different talks about that. But I don't know anybody. I mean, I know some good people, and I don't know anybody with $1 billion in the bank. I mean, the moral of any story, what happened, where the origin went wrong, was they weren't diversified enough, and so. If you're parking your money, if you're parking $100,000 in your checking account, you probably need to go consult with a financial advisor to start having some investments to actually make some money. But then also to protect you, you need to diversify. Don't just put all your eggs into one basket. Again, I'm not the money market guy. I'm not here to advise you on what investments, but there's a reoccurring theme that we're seeing here, right?
Yeah.
Over investing in one thing is not a good thing.
Yeah.
Not having, faith or, in the banking system can just perpetuate and really snowball very fast. And, whether it's right or wrong, I feel the government did step up where they needed to secure all of the assets and losses for the clients. I think they needed to in good faith. I mean, it's one of those, if not, everybody would be going to their regular bank, the Mission Bank, the B of A, and start panic withdrawing their money. And then again, this turns into the toilet paper crisis. Why in COVID that people were sick, did we run out of toilet paper? I mean, it's
right.
We would run out of capital, and then we would totally collapse our banking system for just fear and panic. And it's just not being educated on what happened. This is a lot of reasons. They had their niche of what they went after. Sometimes that rewards very well, but again, I'm going to kind of, lead this into the fault of lack of diversification. And hey, who knows? I'm not even one to even judge them. It happened. The moral I'm trying to get at and just really relay through this podcast to my listeners is listening to professionals like Jason that understands the banking system, how they work. Have faith in your bank. It's okay to ask questions. And if you have questions, read. Don't read the newspaper. Read the financials of the bank. And most of those are public. And so they're published that you can read those. Ask the right questions. And, if you've got $2,000 in your bank, I mean, I don't think you really want to scrutinize the banking platform. You're pretty safe. So yeah.
Yeah, you bring up a good point. I mean, again, if there's a silver lining in the whole thing, it is hopefully people start to learn and start thinking about the banks that they're working with or that they're banking with as businesses, right?
Yeah.
And take the time to ask those questions of your banker, whoever that is. But it is important to think about, one, what you said, panic is not a good thing for anybody, because even the healthiest bank in the world, if all the customers just wake up one day and we're like, we got to get the hell out of there, you can bring any bank down that way. Because like I said at the jump, this whole thing is kind of a confidence game, and it sort of has to be.
Right.
So what you can do instead is start thinking about, okay, we know what went wrong with SVB, so what's my bank doing, right?
Yeah.
How are they, I know they're investing the money that I'm putting there. What are they doing with it? Do they have 60% of it in treasuries that have a similar duration or interest rate risk, right?
Yeah.
Or, okay, is most of it in loans? And if so, what kind of loans are they? And any banker that's kind of worth his salt or her salt will be able to explain some of that stuff to you. So that's an important thing. So, if any good can come from it, it's that like the banks that have been trying to do things the right way for a long time and kind of stick to what they do and what they do best without trying to branch out too far and get into kind of new things and crazier things. Those are the ones that are going to thrive through this whole thing, because hopefully customers are kind of more educated in saying, okay, I want to be with a bank that's kind of doing it the right way.
Yeah.
As opposed to one that's growing super fast or the one that's the largest or whatever it is.
And I'm going to kind of, elaborate on that, where I am a huge believer in the local banks. I call them the mom and pop. They're, let's just say Mission Bank is not the assets and the size of a Wells Fargo, but here's what's good. I called Jason because my email the day of the banking collapse right here, I had a letter from Mission Bank. Your bank reacted the first of all, and I have several different bank accounts, different institutions. Yours was the very first. You were quick to react, and that's where some of the size, your Wells Fargo, and please, any of my mortgage clients, don't ever get a mortgage with them. I don't know if you read in the articles of how many times they're in hot water and they're doing illegal this, and how many times they have some of the largest fines with CFPB. And regardless, they have a thought, well, maybe we should do a letter, and then it needs to go to legal, and then it needs to go to compliance, and then it turns into 2 weeks later, did they even release a letter to address this or not? Day of, I have a letter from Mission Bank that it's addressing. We are your local bank. Let us calm you. Let us tell you what happened. We're here to invest in you. And anybody that lives in the Ventura area, they service multiple areas. I live in Ventura, so I look at what's around me. I drive down Main Street and I see Mission Bank is investing new buildings, condos down Main Street, gas stations down Main Street. This is my community that they're pouring into. So, obviously I want their health to be good, but their health is dependent upon us. They're kind of putting it back into the local community. It goes both ways. They have to trust us. I mentioned I have a commercial loan on this property, and it's kind of a unique property. It's mixed use, it's commercial, it's residential. And, the first bank I went to, they just didn't see my vision. And I went to Mission Bank and I'm like, I've got nothing to hide. Here's my financials. Here's my concept. Here's what I'm looking to do. And they're like, we love it. Let's do this. And it was just no looking back after that. And, I think they understood what I was trying to do. They evaluated their risk on their own. And now I'm vested in them, but they're also vested in me. And so it's these partnerships, credit unions, local banks. I feel that they really give back. And, give back, I'm going to say that they also, Mission Bank was a sponsor, a donor for Love VC. So it goes full circle, right? They do give back into the community and invest in their clients and different projects. And so I can't say enough good things. So I'm high in this cold bath over here of information about Mission Bank.
That's how powerful it is. Just talking about it gets you fired up.
There it is.
Yeah, no, I appreciate you saying all that stuff, because it is everything that you're saying in terms of the partnership and the way that process was for you is what we're fighting and working really hard every day to maintain. Yeah. I don't want to turn this podcast into a Mission Bank advertisement, but essentially we're working really hard to maintain that kind of local bank relationship feel, which we are a local bank, but that kind of handshake, let's sit down and figure this out, instead of, hey, here's the box of our kind of underwriting parameters, we're going to jam you into it.
Yeah.
Let's kind of talk about the project. And so we try to make everything more about the people that are involved, what we know about the community, and making sound underwriting decisions, but also being creative at the same time. We really, really work hard to do that. And I think it's important. But on top of that, kind of in light of the SVB stuff, our CEO will often, from the first time I met him before I came over to the bank, he would always describe Mission Bank as the in and out of banking. And what he means by that is in and out does like three things, right? They do it super well.
Yes.
They're not trying to add chicken tenders. They're not trying to do all this stuff. They're saying, hey, we do this and we do it super well. And we're kind of trying to do the same thing here. We know what our lane is, and we try to do it extremely well, and we do it extremely well. And that then allows us to kind of continue to go down that path. And part of that is making good loans here and not needing to then kind of invest in treasuries and things like that and take on maybe some of that risk that SVB kind of fell into. We do some of that. All banks are kind of required to do some.
Sure.
But the ratio is obviously much, much less than SVB. It's more focused on the community. It's more focused on making small business loans and medium-sized business loans, because as we were talking about earlier before the episode started, the local business owners are the backbone of every community, right? So we want to support them.
Yeah.
That's our main focus.
Yeah. Love it. Thank you. Well, enough about SVB. I'm done with those guys. Let's move on. So commercial banking, I know this is as you mentioned, the in and out, the bread and butter of kind of what you guys do. Again, personally, have a commercial loan, and I've been in the residential lending world for 22 years, and it's I know it well. I'm very confident. I stand tall on that. Products are constantly changing. I try to read up on those. I love helping my clients. I know what I'm doing. And then I went for a commercial loan, and it was like, all right, let me change my hat a little bit, because it is, I've always thought we've had such a parallel industry, and we do for the most part, but it's just, we both do things that each other probably can't do, and that's probably good. And I'm just going to throw it out there. I'm used to 30-year fixed. I don't think you guys know what a fixed is, and you do these. It's amortized over this many years and fixed for this many years, but yet it's doing this many years.
Right.
It's weird and interesting, but at the same time, after listening to us for 45 minutes here and talking about banks and how they have to have liquidity, it all makes sense, right? It's coming full circle of, hey, we can't have this go 30 years. We're investing. This is our portfolio loan, meaning they've lent their money from within the bank, and they're going to retain that on their books, that they need to have that back in a certain amount of time to kind of, circulate through the bank's cash flow. And so, again, it makes sense when you understand how they operate and the type of bank. I'm more heavily weighted on the borrower in qualifying for a mortgage. And a lot of times we talk about this word pre-approval. There's two main components to any transaction. It's the property, and for a purchase, that's going to be more weighted of the appraisal, the title report, even for a refinance. But we don't always have that identified up front. And then we have the other component, which is you, the borrower, your credit worthiness, so your credit score, your income, your assets, your liabilities. And as a pre-approval, without identifying a particular property, we're vetting you. We're looking at your characteristics, your strength in income versus liability, and what kind of debt you could carry comfortably within this debt to income ratio or range. And so I feel like, again, I was, in purchasing a commercial property, I'm standing tall of, hey, I'm a very, very strong borrower, to now I go to the commercial side, and it seems like, yeah, they cared, like, what's my credit score ish? Do you have any bankruptcies? Okay, tell us about the property. We want to know more about the property.
Right.
And so, again, what appears, and I want you to speak to this, a lot more weighted on the property. And my understanding is, how much can you borrow is all in their numbers of cash flow, right? So what is the income of this property? What are the expenses of this property? And what is the liabilities? And it has to have a positive cash flow. They call this debt service. And correct me, 1.25, 1.3, is that kind of the target?
General rule of thumb, yeah.
Yeah, so easy numbers, listeners, here is you have a property with a mortgage payment, taxes, insurance, maintenance, $1,000. You need to bring in $1,300. You need to be 130% of what those liabilities are. And so it makes sense, but it's, again, just way more weighted on the property itself. And so as you're looking at properties, the purchase price is kind of irrelevant. Is it $1 million? Is it $2 million? Is it $500,000? It doesn't matter. It's what are the rents and what are the expenses going to be? And you almost have to manipulate, if it's going to be $2 million and the rents, you have to kind of calculate how much money you have to put down. A minimum, my understanding is somewhere about the 30% range. Do you have to put 30, 40, 50, 60% down to meet that debt service range? And so this other aspect that really came to me, and this is, again, I feel like I'm grateful and I'm thankful of the commercial building that I was able to acquire, but it's the next level of capital, right? So like, a house, you can pretty much buy any house for 20% down. And so this is like starting point. We're going to stick our stake at that 30% mark, but that's our starting point. You might easily need 35 or 40%. And I'm just saying for the most part. Now we'll dabble briefly on SBA loans and little stuff like that, but I'm just talking general commercial. This was kind of that mindset or game changer for me. Is it's all vested in the property. You know, we got to make sure. And granted, I get it. This is the security instrument, right? This is what's going to repay your note, and it's the confidence that you feel in the ability for it to be repaid. Is that it's not like break even, but then I get some extra expenses or extra maintenance costs, and now I can't pay your mortgage. This is your underwriting decisions of, and it's not yours. I'm sure it's pretty standard in your industry of a lot of the ratios and percentages. But then there's also probably a senior VP like Jason that can make some overrides here and there. So I'm just giving you my take. Maybe you can just give me a quick little rundown of like, hey, here's truly what we're looking at, and you hinted at 75% crap. 25% correct. Please clarify for me.
Yeah, pretty much everything you said is correct. I'll just add a little bit of color to it. So in terms of like the way you look at the underwriting for doing the financing that you do, I mean, as you said, it is based on net worth, it's based on income, and it's based on the value of the house, right? It is similar for us. There's just more variables involved. For one, there are less people ready, willing, and able to buy a property like this than there are just kind of your standard 3-bedroom, 2-bathroom house. Right, so it's that reason, among others, but that's probably the primary reason that it's slightly riskier to land on a property like this, which is why we spend more time kind of diving into like the specifics of the property, which is why, hey, Greg, we know you qualify for the loan, but we want to talk about the property a little bit because we want to understand kind of the merits of it, what your plan is for it, how much what the potential is for income and all that good stuff, because there just aren't as many buyers lining up to do this. So we want to make sure that we have to be a little bit more conservative in the lending that we do there. So the income and all that stuff of the person definitely matters. We wouldn't lend, we're not asset-based lenders, so we're not lending just based on, the property by itself. But assuming all that stuff is good, then we care about the property a lot, right? And so you said earlier that, every bank's probably similar, or commercial bank is similar in their underwriting standards, and that is mostly true. There are some that will kind of weight more towards the value of the property. For us, in good times and bad, we want to be consistent, right? We want to stay to where when things are really good, we're not going to just say, hey, values are going up, so we're going to just lend based on the value of the property. Because when banks do that, especially commercial banks like us, when times are bad, those banks are usually the ones that say, hey, we're no longer lending on office. We're no longer doing construction loans. We're no longer doing this or that or the other thing. We never want to have to do that, and so we keep consistent underwriting standards along the way so that we can continue to lend on office buildings for the right transaction, but we can continue to lend on office buildings even if the entire economy is saying office building is a bad investment.
Right. And this is also what we're kind of hearing in the media right now as a result of these collapsed banks is I'm hearing risk is going to be a lot more scrutinized of lending guidelines tightening up and things like that. And so I'm hearing what you're saying loud and clear. And I, again, and just more kudos to Mission Bank with looking at it long term, not just in the short term when times are good. Yeah, we all make money and things are great, but every day, how do we sustain ourselves when times get tough? And it doesn't take a rocket scientist to look at the history of real estate and the cycles that we go through. Everything's cyclical, right? Yeah. And so it's just, does our memory recall the last cycle that we bared this, and what did we learn from that? And so thanks for sharing.
Yeah, no problem. So we dive deep into the person. The people matter a ton to us, right? So we care a lot about the people that we're dealing with. Obviously not going to name names, but there are people that like qualify on paper that we're just like, I don't feel right about doing this loan, right? For whatever reason, there's just something in there. So the people matter a ton.
That's not me, by the way. Thank you.
Yeah, not you. And then the property matters a ton. And then the other variable that's involved is kind of, we're business lenders too. So a lot of times it's a lot of owner-occupied purchase financing and things like that. So from there, we're looking at the business as well and understanding the risks related to, this is a manufacturer, this is a construction company, this is a retail company, all that stuff. And so kind of trying to understand what are risks involved in there and analyzing their financials accordingly. So Generally speaking, I don't see the underwriting as too much different than what you're doing on your side. There's just more variables that we need to consider. And so we kind of have to understand the commercial side can be a little riskier than the residential side. And so we want to make sure we're doing all the work necessary to make sure that we're making good loans and making the best decisions we can with our customers' deposits, right?
Yeah.
And you said something earlier too about, I'll just touch on it briefly, about the differences in the structure. So typically, if we're just talking about conventional financing, as you mentioned earlier, there's SBA loans and things like that, but just conventional commercial financing, typically you're going to get like 70-75% loan to value. And then you're also going to get like a 25-year amortization most of the time, which amortization means the payment schedule. So that's how a monthly payment is kind of calculated based on a 25-year kind of term. But we'll often have a maturity of 10 years. So what that means for those of you that have probably heard the term balloon payment is that means balloon payment. And a lot of people don't like that. And then even from there, sometimes the rate can be fixed for 10 years. Sometimes it's fixed for 3, sometimes 5, sometimes 7. All of that is done kind of for the reasons that we were talking about with SVB, right? They got caught in a duration interest rate risk. And so we kind of try to mitigate some of that risk by saying, we're not going to have it be a fully floating rate because that's just unbearable for most people. And frankly unfair.
Right.
And so, but what we are going to do is kind of lock it in for an extended period of time, but not for forever, right? Because we want to make sure that we're not stuck in this interest rate trap and get squeezed if the Fed decides to jack up rates, at the fastest rate in history, which they have done.
Right.
And we're just stuck with a bunch of loans that are, in the 3s or 4% or whatever they were like 18 months ago. So that's why we do it that way. But so generally that's our structure, right? So we lend based on the property. And additionally, the one other thing that you also touched on is when it's a commercial property, there's a little bit of wiggle room here when it's owner occupied, but generally speaking, we're trying to get the value and we're lending based on that. But we're also saying when we get a commercial appraisal on a property, we're going to get, hey, Mr. or Mrs. Appraiser, what's the market rent and market net income potential for this property? Because we want to make sure that if this is going to be rented out to a third party, that it's going to be able to support the payments. And if you're purely an investor in a property, that's kind of obvious. You want the same thing. You wouldn't
Right.
be buying it if you were having to shell out money every month for it, right? But even for owner occupied, we kind of keep it that way as well because we want to just kind of have that plan B in place if for whatever reason the borrower's business kind of slows down or something like that. They've got another option and they're not stuck with a slowing business and this mortgage that they can't pay and can't even rent it out to somebody else to help them pay.
Right. And not that we have clients that would ever lie to us, but I will say that they'll tell you whatever you want to hear sometimes in order to get the loan. And that's something that is, kind of difficult to take in. But some of the other stuff that I'm hearing is there's some similarities in comparing and contrasting with residential and commercial in the sense that, residential, I talk about standardized guidelines. So we have the two largest banks, Fannie Mae and Freddie Mac. They're mortgage banks exclusively, and they set the guidelines for us lenders. And really, that creates the stability in our industry because, if we're having a financial tough time and we need to have that liquidity, we just sell mortgages. And so we're able to get $100 million, $1 billion, whatever that number is, off of our books. And because we've underwritten them to Fannie Mae or Freddie Mac, we have what's called a sellable loan. Mm-hmm. And so that was also, again, going back to the days of the stated income loans when they were just these one-off unique loan programs. They were non-sellable. Yeah. And so it jammed up all of the mortgage bankers, the Lehman Brothers, all of that, and it just kind of perpetuated the problem there. Now, with what I'm hearing from you guys in the commercial side, there's a lot of similarities, but you don't necessarily have a standardized, hey, this is how you have to do it. So you have to create your own risk within your bank of what threshold and what niche you want. But you guys also have much more stringent requirements for that reason that, you need somebody that is well qualified. They're not just buying a $2 million property and they've, squeaked every dollar into getting it and they have nothing left over. They're well positioned to afford that property. then you're very conservative at looking at the rents to make sure whether Johnny business owner that's in there and he vacates, that a third party could come in and similarly rent it for equivalent.
Exactly.
And that's great. I mean, I'm just hearing again, you're mitigating the risk and you're thinking through that whole process, even down to the loan programs that I suggested are wacky in a certain way. It's just because I'm not used to it. Now think about it in a residential way. We do it how ass backwards. We're committing to the borrower that you're going to get a fixed interest rate for 6% for 30 years. Now you balk at it now where you're accustomed to 3%, but 10 years from now when rates are at 9%, we're actually upside down in what we could potentially make.
Right.
And so this is that risk that the mortgage bank is taking on. And every time I sit down with a client, I've got one word for them that just helps them to understand everything. I'm like, risk. Risk. This is the number. If you ask me, why do we have this guideline? Why do we have that guideline? It's because of risk. And I always flip it back to them. It's what would you ask for to lend $1 million of your personal money? How much information or data would you want without being necessarily intrusive? But it's like, that's a lot of money over a long period of time. And so you have to understand, what it takes in a business-like setting to kind of navigate through that. And so again, I feel like the pendulum's at a pretty good standpoint in the residential side. How do you feel it is on the commercial side?
On the commercial side, things are good. I mean, things slow down a little bit when interest rates go up so much, right? Because you have a lot of investors that are buying stuff purely for return, right? So interest rates go up and you have to borrow money. That eats into your return. So you're going to have automatically, when rates are up a little bit, people less willing to buy until prices start to come back down, right? It's similar to the bonds in the portfolio that SVB invested in. If the interest rates are going to eat into your return, you're going to be willing to pay a little bit less for that asset, right? So you're seeing prices haven't really come down yet. So you're seeing a little bit less activity. There's less people, 18 months ago, my phone was ringing off the hook. I'm sure
Right.
same for you.
Yeah.
My phone was ringing off the hook of somebody that wanted to buy this property over here, mostly investor stuff. So that, at least from what I'm seeing, that has slowed down a little bit, unless you're seeing people that are looking to improve it because they think they can get their return that way. Or various kind of case-by-case things. So on the investor side, I'm seeing it slow down a little bit. But on most of what we do is kind of small to medium-sized business banking, right, which inherently involves a lot of owner-occupied purchases. That activity is still there because business owners are thinking about it in terms of like, what's the right thing for me? There's still not a ton of supply. So the moment a property kind of pops up that fits for them, they're growing really fast. They need to add more people. They've got more trucks. So they need a space to put all those people in all those trucks. Where they're renting right now is either too expensive or it's about to get too expensive or it's not big enough or a combination of all the above. We want to buy something. That activity is still there because what I'm seeing is the business owners in town, even though the economy is a little bit weird right now, the business owners are doing well. Our local Ventura business owners are strong and doing well and staying busy and all that stuff. So anything that's kind of directly or tangentially related to that is still staying very active.
And that kind of brings a viable point, and it goes, to me, full circle back to the importance of local banking, local lenders, local products, of supporting that. Because when a large bank, and I continually pick on Wells Fargo, we'll just say Wells Fargo, they're making decisions not just nationwide but internationally of where they cover. And so when you have a footprint like Mission Bank, where Kern County, San Luis County, Ventura County, whatever counties you're in, you kind of get a sense of that market. And Ventura is a very atypical market to, I'd say, the current economics right now. And it is interesting that a lot of businesses are still thriving. Our housing values have not plummeted. We're not seeing what other people are seeing. And part of that is, what industries are we heavily involved in here? And the other part of that is, I look at what's our surrounding areas. In 25, 30 miles in either direction. We're either in LA, Malibu, Santa Barbara, Santa Ana. I mean, it doesn't matter. We have these high, just dollar. We're a bargain here in Ventura. Yeah. And for $1 million, you can still get an ocean view in many places. And so, I think that kind of changes the dynamic, changes the real estate. And quite frankly, real estate's the driving force in most GDPs. I mean, the turnover, the improvements when somebody buys a house, the Home Depots of all of that. And so it really helps out the economics of that local area. And so with you guys investing in that, I'm seeing, a strong market. I know that there's a recession. Our days are numbered. But if you look at history, and again, the cycles, housing comes out swinging after every recession. Yeah. And that's, interest rates will come down, and then it's going to put us back in that cycle of, that our phones are going to be ringing off the hook. And, and for us in the interim, it's nice to almost have a little bit of a break, I call it. I've been able to work on other things, my nonprofit, my podcast. I'm really developing my skills. I'm getting licensed in other states. I'm out there working in different ways to still promote what we do. Awesome. It's given us a little bit of a breather, saying, okay, I can't work 14-hour days forever. It's just, it's not sustainable.
Yeah. And you're right about what you said about Ventura too. I mean, I'm not from here originally, as we talked about in the beginning, but I've been here for about 10 years now. Yeah. And there is this, the geographic location is obviously the ocean, but, Malibu to our south and LA to our south and Santa Barbara to our north, just all these really nice places. But you drive around here, nice places, obviously, but there's obviously room for improvement too. So you get this feeling that like Ventura is just on the up and up, and it has changed significantly in the 10 years that I've been here. And I see that continuing just from the people that I'm talking to, like the local investors and local business owners that are very, very interested in continuing to improve certain areas of the city and kind of make it bigger, and which is going to attract more people and more businesses and just kind of be this kind of flywheel that keeps things going. So I'm pretty bullish on Ventura for those reasons, even if we're starting to head into a recession. Yeah, absolutely. It's a very unique place for a lot of reasons. Yeah. The other thing I'll say on interest rates too is, the Fed increased interest rates again yesterday, right? 25 basis points, which is small relative to what I think they did 25 basis points last time too, but small relative to what they had been doing. A lot of people aren't happy about it. They even kind of messaged that this might be the last one, or, so I do have a feeling, just given everything that's going on and some of that interest rate risk and duration risk that happened with SVB and some of those other banks, and just kind of potentially the concern about what other banks are out there that are in a similar position to SVB that we just don't know about yet. I have a feeling interest rates might start to come down.
Yeah, we're real close. I feel like you said, the speculation that we have is this quarter that was just increased, probably another quarter, and then we're at the peak. We're peaking right now, but what the Fed does is they overdo it, and that's what they do not give it time. When you raise interest rates, and you do it month number 1, and then month number 2, you go meet and you go, okay, how's things going? How fast can change occur? And so what they've done is let's meet, raise. Now you're pulling the e-brake so that you don't even know it, but you've pulled on that handle so hard that by the time it catches up, you've completely stopped traffic. Yeah. And then they're going to go, oh goodness, we got to get the economy going. Let's take off that e-brake. Let's go time. Let's lower the interest rates, and then they overdo it. And that's kind of what they did during the pandemic. I know is needed. We'll call it unprecedented times. However times we heard that word, right? It was something unique that nobody had dealt with before, right? Yeah. It was scary in the beginning of, I can't go to work. Like, I can't leave my house. I can't go to the grocery store. That kind of causes panic, but then people navigate through that. And I'll steal your word here. The silver lining out of that is how many people were able and now continue to work remotely from home, right? Yeah. And so businesses got to see that, hey, business is okay. They can still be productive at home. And so, I think an unfortunate circumstance has, perpetuated the housing. We're near we're at this uncomfortable level, but I feel that people are coming out and saying, hey, I'm still ready to buy. And that's what I'm excited about, is helping those people that will allow me to speak to them, not just speaking to your brother that's in construction and your uncle that sells cars. Speak to the professionals of what you're looking to do. If you're looking to, buy a commercial building, don't talk to me, talk to Jason. If you're looking to buy a residential building, talk to me, talk to the professional in that industry of what you're wanting to do, and just zone out, filter out the other gibberish out there of what ifs and the speculation and those waiting for the market to crash. If I had $1 for every time I heard that, it's just, I can't relay that enough, of always consult with a professional. If you're interested in something, that's the go-to. Talk to the people that live it, work it, see it, feel it daily. This is their life.
Yeah. So. Yeah, it's not enough to just catch headlines or catch what's kind of out there in the zeitgeist, because a lot of time that is designed to catch your attention, so it can scare you.
Yeah.
Which is a lot of what happened with SVB. So,
I think we're good. I mean, I had probably some more questions, but I feel like we covered a lot of good topics. I don't want to just kind of drown it out and filter. And, I think I've got to have you back on, because I will, kind of dive more into SBA and stuff like that. But,
sure.
I think for the listeners, this is a good enough information to kind of, again, have some takeaways, some confidence about your banking system, understand a little bit about the commercial loans, how we're similar yet different, and how we work together. And so I appreciate your time. You've been very insightful.